An entire kingdom nearly collapsed, not by invasion but by a paper promise. For years, the South Sea Company promised unimaginable riches, a financial elixir for a nation burdened by war debt. It offered a seemingly golden opportunity, a chance for ordinary citizens and the aristocracy alike to become wealthy beyond their wildest dreams. What followed was a frenzy, a mania that swept across Britain, blinding even the sharpest minds to the fundamental flaws at its core. This wasn't merely a stock market fluctuation. It was a national delusion, a speculative fever that infected every level of society, from the lowest commoner to the highest echelons of government. The consequences would be catastrophic, threatening to destabilize not just individual fortunes, but the very fabric of the British state. To understand the South Sea Bubble, we must first look at the geopolitical landscape of early 18th century Britain. The nation had just emerged from the costly War of the Spanish Succession, leaving it with a staggering public debt, amounting to around £50 million, an astronomical sum for the time. The British government, desperate for a solution, sought innovative ways to manage this crushing burden. Traditional methods of taxation and borrowing were proving insufficient. They needed a grand scheme, something bold enough to capture the public imagination and unlock new sources of capital. Enter the South Sea Company, chartered in 1711. Its stated purpose was to trade with the Spanish colonies in South America, the South Seas. This was a tantalizing prospect, promising access to vast markets and untold riches from gold, silver, and exotic goods. However, there was a fundamental problem. Britain was still at war with Spain. The company's trading rights were entirely theoretical, contingent on a future peace treaty. This crucial detail, though known to some, was largely overlooked in the initial wave of enthusiasm. The real genius, or perhaps the ultimate deception, of the South Sea Company lay not in its trade prospects, but in its audacious proposal to the government. In exchange for exclusive trading rights, the company offered to take on a significant portion of the national debt. Bondholders who owned pieces of the national debt were encouraged to exchange their government bonds for shares in the South Sea Company. The company, in turn, would pay these bondholders a steady dividend, ostensibly from its lucrative trade profits. It was presented as a win-win. The idea was simple: consolidate the debt, reduce interest payments, and give the public a stake in a supposedly thriving enterprise. It resonated deeply with a public eager for prosperity after years of conflict. This carefully crafted narrative began to take hold. By 1719, the South Sea Company was ready for its grand play. It proposed an even more ambitious scheme: to take on nearly two-thirds of the remaining national debt. The government, desperate for a solution, embraced the offer, despite skepticism from some within Parliament. The company's stock price began to soar, fueled by carefully orchestrated rumors and an aggressive marketing campaign. Prominent figures, including members of the royal family and leading politicians, openly invested, lending an air of legitimacy and exclusivity to the scheme. In January 1720, the South Sea Company's stock stood at £128 a share. By March, it had rocketed to £330. The public, seeing these incredible returns, became swept up in a speculative frenzy. Everyone wanted a piece of the action, fearing they would be left out. The company employed a host of manipulative tactics. They offered loans to buy shares, effectively allowing people to invest with borrowed money. They spread exaggerated tales of wealth from the South American trade, even though actual trade was minimal. The mania peaked in June 1720, with shares reaching an astonishing £1,000. Fortunes were made overnight, or so it seemed. Servants became richer than their masters, and social hierarchies were momentarily inverted by the promise of easy wealth. This unprecedented success spawned a wave of imitators. Scores of new companies, many with vague or utterly nonsensical proposals, sprang up, eager to capitalize on the public's insatiable appetite for speculation. These were the so-called bubble companies. One famous example was a company for carrying on an undertaking of great advantage, but nobody to know what it is. Its promoter raised £2,000 in a single morning, then promptly vanished. The absurdity of these ventures highlighted the irrationality gripping the nation. The South Sea Company, ironically, became concerned about these smaller bubbles siphoning off investment. They lobbied Parliament to pass the Bubble Act, which aimed to suppress rival companies. This act, intended to protect their own scheme, inadvertently began to prick the larger bubble. As summer drew to a close, cracks began to appear. Savvy investors, sensing the unsustainable nature of the growth, started to sell their shares. The initial trickle of selling soon became a flood. Confidence, once unshakable, evaporated almost overnight. By September 1720, the stock had plummeted to pound 150. By December, it was a mere pound 12. Thousands of investors, from wealthy aristocrats to ordinary tradesmen, were utterly ruined. Fortunes amassed in months vanished in weeks. The aftermath was devastating. The economy plunged into crisis. Public trust in institutions, particularly financial ones, was shattered. There were calls for revenge against the directors of the South Sea Company, many of whom had enriched themselves while misleading the public. A parliamentary inquiry was launched, revealing widespread corruption and insider trading. Directors were arrested, their estates confiscated, and some even fled the country. The Chancellor of the Exchequer, John Aislabie, was implicated and expelled from Parliament. The government, led by Robert Walpole, stepped in to mitigate the damage. A complex rescue plan was devised, involving other major financial institutions like the Bank of England, to restore some stability and compensate the victims, albeit partially. The South Sea bubble serves as a timeless cautionary tale. It underscores the dangers of unchecked speculation, the seductive power of easy money, and how easily collective delusion can override rational judgment, even among the seemingly astute. It also highlights the crucial role of government regulation, not just to prevent outright fraud, but to temper the irrational exuberance that can lead entire economies to the brink of collapse. Next, we'll explore the tulip mania, a financial frenzy driven by a flower.